The Money Show. Personal finance.
Warren Ingram from Galileo Capital with personal finance this evening. And Warren Ingram, we got an email last week, and the email was all around what is happening with stock markets and should I be selling? The question is, should I be selling my shares? Should I be selling my unit trusts and investing in the money market? That was the question that we got last week. I handed it to you, and I thought to myself, it is now time for you to answer that question. Because if 5 years ago I had said to you, Warren, should I put money into shares or into fixed investments, you would have said, put them into shares, and I would be poorer today as a result, wouldn't you?
Well, you wouldn't be poorer, but you wouldn't have.
I'd be poorer than if I would be poorer than if I put money into fixed interest.
Oh yes, and that's incredibly unusual. I mean, so over a 5 year period for money markets to beat the stock market by more than 1 or 2% a year over that time is really unusual. And so if we were chatting 5 years ago and then having the conversation again today, you'd probably rightfully would be very grumpy with me. Even more grumpy with me than usual.
Jeez. You wouldn't be able to walk. So it brings us to this question now, because we're at the end of this 5 year cycle, and over the last 5 years, the all share index is given, is at what, 5% a year? Over those 5% overall?
No, 5% a year. But so 5% a year for 5 years. And, if inflation's running at slightly higher than that over the same time, you've got the JSE not delivering, not even delivering inflation-beating returns, not even matching inflation. And then cash, doing more than that, so around about 6.5%, nearly 7% a year over that time, and so really unusual situation. And I think a lot of investors, are in the same boat as the person who wrote in to say, I've been in a balanced unit trust for a time, and things are not going well. Why don't I just move to money markets? And I think it's a fair question. I just think it would be a real mistake now.
Oh, now, again, if you looked at the numbers on Monday, and you said, well, so far this year, the JSE is up 7%, and that was really good. But that was on Monday. And since then, the JSE's lost about 5% of its value. We're back very close to where we started at the beginning of this year. The huge volatility in markets is the thing that I think scares so many people from actually committing money to it.
100%. And I think that, that's the thing. If you're you need to make a decision, I guess, if you're an investor, to say, do I live with volatility or do I buy certainty? And that's really the core decision in a conversation like this. So if someone says to me, certainty is much more important to me than actually worrying too much about long-term inflation beating growth, then I'd say, well, if certainty is your driver, then by all means, invest in cash and get the interest rate return. And it's almost impossible over a period of time that your money will ever go down if you invest in a money market fund. We need a whole lot of kind of big African bank size kind of collapses to happen for you to really lose money. But the price that you're going to pay for that decision and for getting that certainty is that you're in a position where you are not likely to beat inflation over time, and certainly will sacrifice any possibility of a big recovery when stock markets do eventually deliver growth. And I think that's the point here is, stock markets have a long history. In South Africa, it's way over 100-year history of doing 6 nearly 7% a year above inflation. And so, to me, looking at this kind of situation now, and especially, with the horrific start to October, I agree, it's terrible for investors. There's no way to work around that. But what I would say is that, when I looked at these numbers on Monday, I said that I think the JSE is already in dirt cheap territory. I don't know what's cheaper than dirt cheap, but we're there now. And so to me, the potential for big recoveries kicks in as we're in this territory.
And markets, you will tell us, are for the long term. If you want to talk to Warren and shout at him, I will encourage you to do so. If you want to shout at me, that's a bad thing, but we'll pick on Warren evening. 021 446 0567 011 883 0702. If you want to have a robust debate, a robust discussion with Uncle Warren this evening. John Maynard Keynes told us, in the long term, we're all dead. And if 5 years in markets is the long term, because that's usually what we're told, we must put money into markets for at least 5 years. If you don't need the money in the next 5 years, you can invest it in markets, and that's usually very good advice, because 2, 3, sometimes 4, or even 5 of those years can be really positive for stock markets. They seldom go up in a straight line, but they also seldom flatline the way they have, rising at below inflation for 5 years constantly. And that's precisely what has happened in South Africa over those 5 years. Markets have underperformed inflation. You are poorer today by putting money into shares on the JSE than you are had you simply put money into an account that gave you 6 or 7% interest a year.
Is that a question?
It is a statement that requires a response.
It's game on. So that's a fairly close to perfectly accurate statement, and no argument there at all. I think the point here is that as this trend continues, what it's telling me as an investor is that the likelihood of a substantial recovery in the JSE becomes greater and greater, and the likelihood of a bigger recovery becomes even greater. And I think that's the point here. And so my logic, it's not because I'm smoking the smog in Joburg. It's because eventually what happens is we get what the mathematicians call mean reversion. So if something swings too far in one direction, eventually it swings back. Whatever goes up must come down, but whatever has gone down in markets for too long eventually comes back. That doesn't always apply.
If the environment in which the market is operating is one that is showing signs of life, if it is a hospital patient, however, in ICU, and there is a power cut, because it is a South African power cut and somebody forgot to fill the generators with diesel because, hey, it was too expensive, and the patient now is sucking oxygen, desperately trying to stay alive, that is the state of the South African economy right now. There's no guarantee that this economy recovers to a point where it becomes supportive of growth in stock markets.
That's true, and so one, if you're an investor, you need to understand what you're buying when you buy the South African stock market, and so and then I would say that you might want to exercise some caution when buying the market. So your example of the generator is a good one, and will certainly apply to a lot of the smaller companies listed on the JSE. There are some of the big ones, but not many, that are solely focused and solely invested on what happens in the South African economy. But when you look at the overall JSE, there's actually a huge proportion of these companies that really don't have a big focus on what goes on in the SA economy. So my easy example that is to look at something like Naspers or Prosus and Richmond and British American Tobacco. They earn, in percentage terms, pretty much close to nothing from South Africa, and earn the bulk of their money globally. And so, when we look at the JSE, I mean, your comment is fair. That's what most people are thinking now, is that, the economy in South Africa is, really in the doldrums, and we don't see any turnarounds and nothing's happening. And so why would we buy the JSE? Well, you buy the JSE because actually it's kind of a proxy. It's a quite an effective proxy for what global investors think about emerging markets. And so that's the trick here, is that, don't get too focused on the bottom half of our stock market where the smaller companies are, because actually overseas investors don't buy the bottom half of our market. They buy the big companies. They buy probably only 60 out of the total markets or total shares of the JSE. And so when they feel that the world, forget about South Africa, but when they feel like the world is in a slightly better place, then they tell their trader to now buy emerging markets, and that's pretty much as much work as they do on that. That trader then pushes a button to buy shares in emerging markets, and it might be a fund, it might be an exchange traded fund or a unit trust or whatever, and so what happens then is money flows into emerging markets, and our shares go up. And so, I mean, the best example I can think of that was, the rand strengthened on the day that it was announced that Jacob Zuma was elected as head of the ANC. And that certainly wasn't overseas investors looking at South Africa and saying, wow, here we go, this country's going to boom. That was just, it happened to be a good time for emerging markets. And so our rand strengthened.
Here's a question from Ray in Bedford View. Hello, Ray. Thanks for your patience. Tell us your question, please.
Hi, gentlemen. A quick one. Buying the JSE, why not just buy, preference shares in any of the four big banks and sit and hold tight? You're getting 7%, whatever they're offering.
Is that the return that you're getting on preference shares, Ray? I mean, in the ballpark, I haven't looked at preference share returns for a while, but is it in the region of 7%?
I haven't, but that's what I believe it is.
Okay. I've got a counter-argument to that one, Ray. I'm interested to hear the professional's opinion on it as well. Ray, buying preference shares in any of the banks and sitting tight. Why put your money into a money market account when you can invest in preference shares, Warren Ingram?
Well, I think the pref shares are nice. I think there's no concern in terms of that yield. I think he's probably quite close to right in terms of what they're paying out. The two comments will be that it's a certainty. In other words, that 7% is a function of the interest rates in South Africa. So they pay a percentage of what the prime interest rate is. Yes, it is tax free, but the big thing about pref shares is that you're not going to get any kind of return beyond that. That's what you're going to get. And you do have the possibility, and it's happened quite a few times in the last few years, that your capital actually goes down. And that tends to happen when there's a question around dividends tax, increasing, or the potential that the bank's capital is going to change, and they don't really want prefs anymore, or the like. So what we find there is that. Initially, when these came out, people thought, wow, this is just, like the banks, the banks are pretty secure. They're going to pay this dividend forever. And then suddenly, dividends tax came in, and then it went up, and suddenly the yields really became rocky. And you could see a 10 or 15% swing in the value of your capital and that you put into what was supposedly a safe investment.
So if that is as risky as you imply that it could become, because they're perceived to be incredibly safe, why not simply buy the shares of South African banks? And this is where I come in, Ray, with an alternative idea, and that is because the dividend yield on South African banks are in the region of the same sort of quantum as a preference share yield. At the moment, the Absa dividend yield is sitting at around 7.5% or thereabouts, and if you buy the share and you get a dividend yield of 7.5%, if you get a really decent dividend yield, plus you also get the potential upside of a share price gain. And if you're not somebody who's ever going to sell that share, well, you've locked in a price on that share, and you get to get your dividends paid out. Warren?
I mean, it's a brilliant comment, and I think a lot of the time, you're still going to have the capital volatility either way. So whether you bought the pref or the normal share, and as you say, the problem with the pref is that it can be volatile, but your yields are not going to change much. Whereas the dividend yield, it's likely that the mean reversion that I spoke about will kick in. In other words, if long-term banks should be paying out a yield of about 3.5%, then that means that the share price really has to rocket for that yield to come back into its long-term average. And that means, if you're looking at that and you're, let's say, a big pension fund, and you're trying to say, well, where can I get the potential for good income for my pension fund and maybe some capital growth, then you'd be looking at the banks in South Africa and saying, well regulated, they don't have, we don't see big blow-ups of big banks in South Africa, and I can get this great yield, and I can get the big potential capital unlock. And I think it's a great call. And so for private investors, the only downside is you have to make that long-term decision. You have to say, I'm in this, and it might take a couple of years for that price to unlock and to go up, but that's the deal. That's the point about being in the market. So what I would say is, don't necessarily only buy one bank share, maybe buy a few of them, because I think they're all trading on very good dividend yields.
What's happened, and again, an unfair question because I haven't asked you to check this out, but you may have because you're the consummate professional that I know you are. The Satrix Dividend Plus, that was one of the first ETFs ever created. Is that still flying?
No, it did fly, and it had a really great start, and then it had a really terrible a period of time. And then they kind of rejigged that, that quite a bit. And so I truthfully haven't looked at it in the last while, but it looks very much like the whole of the JSE, but just actually a lot more volatile. So, I would be saying to investors, look, you're getting such good dividend yields across the bulk of the JSE that you don't really need to focus specifically on a divvy type type ETF, if you can buy the bulk of the JSE, and the dividend
You can build a
yields.
portfolio of your own of more secure shares that you have a long-term view on with decent dividend yields.
Yeah. So just to go all the way back to your kind of doomsday question, if you are really worried about the economy, that's the one thing about the banks in South Africa is they do earn the bulk of their money from the South African economy. So they will take a lot longer to potentially recover their capital price or that share price than some of the other companies that are listed on the JSE. So to me, it would certainly be a combination.
Yeah, I agree with you on that one. Moira, who is in Claremont, says, what if you are 80 years old? Should she be selling shares as an 80-year-old and going into cash? Moira sounds like a sprightly 80-year-old.
So I think it's a good question because time frames for an 80-year-old as an investor compared to a 20-year-old are clearly different, and so that is a factor, and I'm going to park that one for a second. But the other thing is, selling out of a market which is cheaper than dirt cheap. To me, at this time, I would be really careful of doing that. I just think I think we're at kind of the peak fear stage at the moment, and that's usually just before before markets turn. And again, I'm going to use that comparison of cash beating the stock market over 5 years is always a great buying signal to sell cash and to buy shares. So unless Moira actually, for example, knows that she needs money in the next year or two, if she doesn't need money in the next year or two, then I would be a patient holder of my shares for now, and just to see how the story unfolds a bit, because it doesn't take a lot of good news out there in the world, and I'm not saying South African good news, but just global good news. If Trump shakes hands with China and they solve their trade war, the markets will recover, and emerging markets especially will recover.
And there's also the potential of a South African turnaround. Now, there is a great deal of skepticism in some circles about whether the ANC NEC is going to allow Tito Mboweni enough rope with which to hang himself on his economic policy turnaround plan. But Nazmira Mula at Investec Asset Management this evening was very optimistic, or hopeful, I think was the word that she used, that the ANC is sufficiently supportive of Tito Mboweni's turnaround plan to allow it actually to do some good in this economy and get us at least above 1% growth, which is more than we've got at the moment.
Well, interesting that you mentioned Nazmira, because if I recall, she was, I don't know if she still is, but wasn't she on the board of Transnet at a point in time? And
she was on the board of SAA for a while and then wasn't anymore.
And so why mentioning Transnet? If you look at the performance of the kind of the bulk side of Transnet, the place where they move iron ore from Sishen to Saldanha and again the manganese operation, those are doing really well. Those are suddenly starting to actually perform, and from what I've heard from the listed companies that are interacting with Sanral, for example, saying that Sanral is starting to initiate projects again, and so some of the stuff that we don't really hear about that maybe doesn't get a huge amount of exposure, there are things that are happening. This mining in Durban is interesting because I chatted to one of the unlisted miners, and they were saying they're getting big support from the Department of Minerals now, and it's gone from an adversarial relationship to a much better relationship. And so, instead of government being a hindrance to business, I'm not saying that they're delivering all the best policies and giving huge support, but the point is they're at least getting out of their way so that they can do business. And to me, those are things that will take a little bit of time to filter through. So we haven't even had the positive South African argument because, all the doomsdayers will start abusing us now on social media. But the point is, there is a heck of a lot that can happen. There is a lot of low-hanging fruit that can deliver some economic growth without kind of the privatization or, the sale of coal-fired power plants, etc., that we'd all like, or, easing up on labor restrictions for small companies or whatever the deal is. But just doing simple stuff that's not politically problematic for the unions, for example, we can actually get things going. And I think I have a feeling that is happening. It's just not happening at the speed that we'd like and not with the big fanfare. But all of that points to a whole range of factors why someone doesn't sell the JSE now, and why either they hold, or if they've got a long-term time frame, they should be selling their cash and buying shares.
And there is the sort of, just to balance it off, to say that we have absolutely no idea what the future looks like. I mean, the future could be worse. The future could be better. On balance, I think humanity is sort of pre-designed to assume that the future is better than the past. Otherwise, why do we keep taking breath every single day if we're going to be that pessimistic? And if you're an optimist, if you are an optimist in the fact that you believe that life in South Africa is going to be better 5 years from now than it is today, then that implies that you believe that growth will improve, that more people will get jobs, that there will be more opportunity in the South African economy for people to expand their horizons and to have some spending money and to support local companies, all of that sort of stuff. Then comes to whether or not you are an optimist in the future of South Africa or a pessimist. And if you're an optimist, well, then you're mad not to invest. And if you're not investing, then maybe you're not really an optimist, Warren Ingram. Last comment that requires a comment back.
And I think you've told me about that. Was it a Pete Maton quote about pessimists never built anything?
Negative people never build anything.
Negative
yes.
people, yeah, and I think that's the point. In an environment like this, how many great businesses have kind of restructured themselves, positioned themselves to deal with the tough times, and when the good times, and I'm not saying they have to be great times, but just when they go from being tough to okay, how those companies start to perform. And I think that's the point here. You're not selling a thing that just exists in the ether. What you're doing when you sell the JSE is you're selling a collection of some potentially really great businesses, yes, some average ones, but you're saying that those businesses will never make money again. And I just don't think that's logical.
Thank you, Warren Ingram. Warren Ingram is a financial advisor. He's a director at Galileo Capital on this evening's edition of The Money Show.